Hello, everyone. My name is Dan Veru from Palisade Capital Management. I have a quick update on both the CPI report that came out yesterday and today's interest rate move by the Federal Reserve. Yesterday, the government reported that the Consumer Price Index CPI report showed a reduction in inflation to an annualized rate of 7.1%. While this is still elevated, the numbers are clearly moving in the right direction off of the peak numbers that occurred several months ago. And everything seems to be coming down in terms of the broader index of prices. 7% is still significantly above normalized level of inflation, so there's a lot of work yet to be done, but directionally it's moving in the right way. Today, as expected, the Federal Reserve raised interest rates by 50 basis points. As you recall, the last time I had the chance to speak with you, the Fed had raised rates by 75 basis points, and that was one of several 75 basis point increases up into that period of time. The new target for short-term interest rates right now is 4.25% to 4.5%. And that also was pretty much as expected. But what wasn't expected was the hawkish tone that Chair Powell had during his question and answer period. And he indicated that the terminal rate for short-term interest rates would likely be in a range of 5 to 5.25%. That was not expected because one would think that as inflation begins to come down, the need to raise rates so much perhaps would also come down. So investors who were thinking that the Fed might be in a position to pivot on interest rates and actually lower them are going to be disappointed because, as I said, by the end of 2023, they're anticipating that interest rates will be in a range of 5 to 5.25%. So what does this mean for stock investors? Well, clearly, you have to be in the right stocks and you have to be in the right sectors as well. The way we think about it here is to own companies that are generating a lot of free cash flow, are highly profitable, and are also trading at more reasonable price earnings multiples. The era of paying up for stocks is clearly behind us because those stocks are simply not going to work in a rising interest rate environment. And that certainly gets us to where we want to invest. We want to certainly avoid or underweight companies that are losing money. There's a lot of technology companies that are like that, so we would avoid those areas. We want to also be in areas that can be a little bit more defensive, like the consumer staples and healthcare space. And lastly, we still think that industrial stocks, which have been performing quite well as of late, should continue to do well. There's still a lot of stimulus money that Congress has approved but has yet to hit the economy, and that's likely going to affect in a positive way many of the industrial types of stocks that we are looking at and or own. So that's all I want to say for today. I want to wish everybody a very happy holiday and a prosperous new year. And I'll be updating you very early in the new year as we talk about the outlook for 2023. Thank you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.